Good morning, everyone. Thank you for joining us. My name is Wayne Hiller van Rensburg. I'm the Executive Officer of the Institute of Retirement Funds Africa. We're excited to be hosting the webinar today. We'll just go through the process quickly. We have 3 sessions. First one we'll have from Nedgroup Investments. Second from, I apologize, not Nedgroup Investments. It is Old Mutual Investment Group we're starting off with. Then Nedgroup Investments in the second session, and Sasfin Asset Management in the third. Unusual format for the IRFA. We usually don't have, very specific type sessions like this. However, this morning's session is special in that we wanted to make it a investment masterclass and look at some of the things we don't always pay attention to. We're very grateful that all 3 topics being covered this morning are not things that we've covered recently or have not covered in the past at all. So welcome to everyone. Just a reminder on the process. If you have any questions, please post them in the chat or in the Q&A. Alternatively, raise your hand and we will give you an opportunity. As I know that for session 1, the preference is that we will deal with the questions at the end. But before we get there, I want to hand over to the IRFA President Geraldine Fowler to just welcome us all. Over to you, Geraldine.
Thank you very much, Wayne, and a warm welcome to everyone that has joined us, our delegates, but especially to our sponsors, Old Mutual Investment Group, Nedgroup Investments, and Sasfin Asset Management. As we aware, the IRFA is a non-profit organization, and the work that we do in the ecosystem of retirement funds is not possible without our sponsors. So therefore, it really is special for us to have you guys with us. We truly appreciate it. And we all know that in order to create better outcomes for the members of our retirement funds, but not just the members of retirement funds, for the people of South Africa and the African continent, the power of the collective is always better. And therefore, without sponsors such as yourselves, we cannot do it. So I'm not going to talk for much longer. I also just wanted to quickly take this opportunity to remind everyone our conference is the 5th and the 6th of September. You will at conference see Old Mutual Investment Group, Nedgroup Investments, and Sasfin again. We invite you all to please join, register. It is really going to be the event of the year. And then lastly, for all our women delegates that is in this webinar, if I don't see you again before the 9th of August, happy Women's Day. Thanks very much, and back to you, Wayne.
Thank you, Geraldine. Before we get going, and I know Maahir is I'm sure keen to get going after all the work that he's done there. Just a quick intro here. We'll share the slides later on so everyone can read Maahir's sort of qualifications and experience here. So we won't go there. No, the picture looks a little different. Maahir can explain that to us at a later stage. Enough said in the fact that, I mean, this is, we're dealing with a person in an organization of expertise, and what that expertise is going to look at is a whole set of ethical investing principles, ESG, and the conflict between Russia and the Ukraine. Maahir, I'm going to stop here. Just always a reminder to anybody who has any questions, you're welcome to give us a call. You're welcome to drop us an email, either to myself or to my colleague, Putipadu at reception, and we'll get it through to you. And now I'm going to hand over to you. Thanks, Maahir.
Thank you, Wayne. Can you guys see? You guys see my presentation? I felt like I've said that so many times when this virtual presentation happens. Wayne, if you can just confirm that you can see the presentation, and then I'll begin.
We've got it, and we're going to get it on the big screen for us now. There we go. It's right there. You can go. Thanks.
Perfect. So thanks for the introduction, and thanks, Geraldine. I'm really looking forward to this. It is what I do on a daily basis, and I think this masterclass is very important in terms of education, because that's where awareness really starts. So I'm going to talk a little bit about ESG investing, Sharia investing, how it intersects, and then I'm looking forward to the questions as well at the end. So we were waiting for this guy to present, but I'm going to do the presentation. No, I am the same guy. There's a lot going on in the world, so I didn't have a chance really to cut my hair. And I have picked up a few kilos, but it's not important who I am. I'm going to deliver this. It's important to know that I'm a portfolio manager at the Old Mutual Investment Group in the Shariah and ethical investment space. So that's my wall of worry, the thing that really keeps me up at night. And there's a lot going on. There's China, supply chains, valuations, but so, I mean, in terms of a webinar, there's a lot to talk about, but we're going to focus on the Sharia compliant and ESG aspect. Now, sustainable investment thesis, when we looked at the data to see why do companies perform better in the same industry or relative to their peers, there were a couple of characteristics that stood out. And those on the left-hand side, like your lower cost of capital, which is just the way we borrow, how cheap that is to get good business growth, lower staff turnover and high productivity. It really speaks to the culture of the business. Brand trust and loyalty is an important one, and obviously stronger R&D, but also, lower reg risk, which is just the red tape that certain companies have in the arena of operation. So to outperform relative to peers, those were the characteristics from a sustainable level. And I just want to sketch the landscape in terms of also educating the audience of what we are dealing with. So ESG, Sharia, ethical, sustainable investing, whatever you want to throw under the umbrella, really has increased in terms of both flows. There was a record number of flows into sustainable funds up until 2019. And then also, there's been a big interest. So the shift of that interest has shifted from 71% to 85%. But if you look at the graph on the right, it's interesting that, and I think the important thing about the graph on the right, if I can put that up front, is that the flows are still positive into that sustainable space. That's very important. But it has come down somewhat, and you can look at that in various ways. There was COVID, so there was a pent up savings that happened, and then because of COVID itself, people were thinking in a more ethical, moral mindset in terms of, well, perhaps we should be in ESG or Sharia funds or ethical funds. And then there was the opening up of economies, and I think that's part of it, but there was also the war. Now, generally, when we look at flows, there is a strong correlation of good performance and flows. And I think that's important to note. So when the war started, prior to that already, energy was doing exceptionally well because there was an upward trajectory of the oil price. So now while certain ethical funds or ESG funds specifically excluded those sectors and those shares, they would have lagged in terms of performance. So there's that aspect as well. But the important thing I think to take out of this is that the flows are still positive and we are in it for the long term. How does that look? So I've showed you the global graph. How does that look on our side? We are still seeing very good flows into our, I don't want to use the word ethical franchise, but into our Shariah and ESG funds. So we are still seeing good growth. And in terms of just digging down deeper into the landscape and who are actually interested and who's investing, if we just dissect that a little bit further, millennials, there's definitely a growing level of awareness and desire for ethical investments. And we can see that on the Sharia fund side. Now, while on the 60+ age band, there weren't ESG funds and there weren't ethical funds and there weren't Sharia funds 20, 30 years ago. I guess so that also explains why the bulk of the AUM, the assets under management or flows, are within that age band. But I don't think that can be ignored. I also think there perhaps is a bit of a bias because the millennial is telling you that there's an increase in awareness. So don't believe everything I say. But then we also compare that to the industry proxy, which looks very different. The other thing is, which Geraldine mentioned, is it's Women's Month, and there is definitely a larger inclusion of women within the investment space, but also within the funds, if we dissect that. And it's probably good to mention that actually within the Sharia space, 25% of the individuals that make up our AUM are actually of non-Muslim faith, right? So non-Islamic faith, which is interesting, and it should get you thinking about why would an individual that is not Muslim be in a Sharia fund? And it's for those very reasons about that ESG overlay and the moral compass. And of course, there are things like performance, which can be tracked, but it really boils down to what an individual is looking for in terms of investments. So there is a strong intersection between ESG and Sharia. On the ESG side, they're looking at environmental, social, and governance issues, where on the Sharia investment side, it's a principles based that hasn't really changed for over 1400 years. And if we really look at what that means, it's really to do no harm, and there must be mutual benefit. And that brings me to the concept of shared values. Now, what the shared values concept is, especially in investing, is looking at, okay, the economic benefit, the objective of the client, saying, I've got to get the best outcome I can for the client from a commercial point of view. And that's purely based on returns and making those good investment decisions. But in the same time, while making those decisions for the clients, can we have an impact? Can we do something either to the environment or socially that can actually benefit the client in a different way? And that's really what the concept of shared values is. So there are really two tests to get to an ethical universe, and that's the nature of the business. So at the outset, on the Sharia side and the ESG side, we're going to throw out companies, alcohol, weapons, gambling, etc. And that'll be evident on the next slide. But then there's the quantitative test, and this differs between ESG and Sharia. On the ESG side, it's more the perceived controversy score. And then on the Sharia side, it's more about the IRFA rules, which is the Accounting and Auditing Organization for Islamic Financial Institutions. So while it's a mouthful, it's a board in Bahrain that have set certain rules in place from a quantitative perspective. And if the rule breaches, then the company then falls out of the universe. And then post-investment, on the Shariah side, we've got something that I'm going to touch on later, which is called the non-permissible income. And that's going to be quite interesting for those who don't know what that is. So on the ESG side, if we just look a little bit deeper, you have the exclusion of fossil fuels. You have a company that has a low ESG score, whether that's the E, the S, or the G, or all three in aggregate. And then you've got the low UN Global Compact score, which is really takes labor, human rights into consideration. And there are 10 principles there. And then there's the controversies monitoring in terms of, are you using child labor to work in your factories? Have you guys spilled oil in the ocean while drilling, etc.? I mean, on the Shariah side, there are pork products, conventional financial services, which are banks, highly levered companies, which is part of the IRFA rules. And then there's the intersection of ESG and Shariah, which is your alcohol, adult entertainment, gambling, tobacco, and weapons. Now, why this slide is the crux really of this webinar. It's important to know that if you invest in these funds, when the funds are going to outperform and when the funds are going to underperform. Now, in my piece that I put out, which this webinar is really the back of the piece that the thought leadership piece that I put out in our fundamentals magazine, is that when ESG was excluding fossil fuels as well as weapons, you had an increase in oil price, and then you had the war, which exacerbated this. Okay, because Russia is a big commodity company, sorry, a big commodity country. So you had, besides the increase in oil price, the war exacerbated further to run to almost $120 per barrel for oil. It's now currently sitting at 100, so it has come off a little bit. But through that time, excluding companies whose core businesses is doing oil or energy would have hurt ESG performance, right? And then another interesting stat from the Bank of Merrill Lynch, they actually stated that developed countries are increasing their spend per GDP on security, which just means that they will buy more weapons. And while they do this, if you're not holding those companies, well, then your portfolio could underperform. So that's a really, really important slide. In terms of how we incorporate ESG is one, through the investment process. And how we do that is we've got a separate business of 6 or so analysts who sit in our ESG space, who their daily job is only to work on ESG, do our proxy voting, engage with management around ESG issues and how they can better their company's ESG profile. And then in the alternative space, under our green roof at Old Mutual, we've also got an alternatives business, which JV and build JV with other companies and build schools. We've got the impact fund. We've got they put up solar and wind farms, etc. So we've got that. And how we're trying to incorporate that specifically in the Shariah funds is through the sukuks. And then there's the non-permissible income. Now this is very important because I brought it up on an earlier slide. Every single company has an income statement, and in that income statement, it's got an interest income line or a finance income line, depending on how they disclose it. Now, interest income in conventional banking is non-permissible in the Shariah space, whilst permissible in the ESG space, it's non-permissible in the Shariah space. And what we do with that, we look at every single company that we hold, we do a weighted calculation, and we pro-rata that, and we strip that out of our unit price on a daily basis. So just think about that. Here's a fund manager talking to an audience saying that if you invest with me every single day, I'm going to take a very, very tiny amount of money away from your unit price, and I'm going to give that to charity. And that's exactly what we do. And you've seen the flows. Investors that invest with us know that we do that. And we use that money to make a direct impact on the SDG goals. And in terms of all the SDG goals, there's about 13 out of the 17 SDG goals that we hit and make a direct impact in communities. We donate money to education, and just in terms of our AUM this year, we probably donating around north of 27 million. Now, while that sounds like a big number in absolute terms, if you look at it over our AUM of roughly 8.5–9 billion, it's actually not that much, but you can do a lot of good with 27 million, right? So poverty alleviation, health, and then when there's a need, the trust will allocate, like there's a water crisis in Nelson Mandela Bay right now, and then the trust will direct those funds to a need. But the thinking around the trust is also sustainable. And what I mean by that is they would open a baking school in a rural community. That baking school will then employ, make products, sell it out into the community, and that's a cycle of giving money to somebody or to an organization that is where we're not a grant funder in terms of everyone's putting up their hands, I need. So that's the thinking around the trust. So I'm going to take you through a real case study, which I'll incorporate a discipline framework to look at companies as well as the ESG part of it. And our philosophy is really based around high quality companies that are attractively valued and that have a good growth pipeline. And while we do that, we also manage risk. So the famous ice hockey player, Wayne Gretzky, he said, I skate where the puck is going to be, not where it is. And the reason I put that slide in was to show you that we don't always just invest in AAA companies like a Vodacom. We will look at companies where the investment case makes sense and there's an improvement in ESG. So I've put two examples up of Shell and Sasol, and you can see that Shell scores a lot better. And the reason why Shell's got the bump up from A to AA is really around they actually sold off some of their assets that were on the E side, was really what we call an environmental liability. And then on Sasol's side, you can see that they actually dipped and then they came back up to BB. And that was because of a sitting between Old Mutual's ESG team and Sasol to say, this is actually what you guys are not great at. This is what you need to improve. And then on the governance side, they actually put that in place. So from an active stewardship point of view, Old Mutual also plays a massive role in terms of how to get certain companies where they need to be from an ESG arena. In terms of transparency and reporting, Sasol had none of these things. They had no revenue lines in terms of their metrics, and they're only in the infancy of their journey implementing this ESG framework and cycle, which was due to the fact that Old Mutual actually sat down with management to discuss how to do that. But if we look at Shell and Sasol, they basically they basically do the same things. They get in Brent crude and then they dissect those products for bitumen, petroleum, etc. And let's just see how the ESG scores stack up. If you look at the ESG profile score, so 10 is the highest and 1 is the lowest, you can see that Shell is the clear winner there at roughly 7 versus 3, which automatically puts them, Shell, in a better quintile than Sasol. But if you look at the total greenhouse gas emissions, and really that's a fancy name for pollution, and how they affect our environment, and you look at the size of the market cap in terms of the different businesses, you can see that actually while the greenhouse gas emissions of Sasol is very similar to Shell, they're a tenth of the size. So Sasol is really doing a bad job in terms of the environment, while Shell is, I guess, also, but they're a lot bigger, and they have better frameworks in place for that energy transition and that net zero carbon. And then from an investment point of view, if you look at Shell and Sasol and you needed certain exposures to energy, and if you were exposed, you would have done exceptionally well. But just with an investment mindset and with our framework in terms of quality, value, and growth, how do they compare against each other? So cash flow return on capital employed is part of our quality basket and our quality factor. And these are just to unpack a bit of the fundamental metrics which make up our factor basket. We use a systematic approach. And if you look at quality, Shell's got better quality than Sasol. Their default probability, and what this is the ability to pay back their debt, or if they are in any way going to default on their credit. And this is in a percentile, so which means that if you're in the top percentile, you're a lot better. If you're in the bottom percentile, you're a lot worse. And then you can see that Shell is much better than Sasol. And then from an earnings per share growth, on a 3-year average, you can see that Shell has done a lot better. And then from a valuation, cheap or expensive, attractive or not, if we look at the PE ratio over there, the lower the PE, the better. So Shell, from an investment point of view, a clear winner. So with our framework, quality value, Shell has better quality, attractive valuations, a good growth pipeline. I mean, Shell is one of the largest liquefied natural gas plants relative to peers, and it's got decent and improving ESG, which we believe is best in class in the energy sector. And then I had to put this in, and this is really not to show the incredible performance. Well, while it does do that, it's more to debunk myths. And what do I mean by debunking myths? I often get asked the question that Shariah compliant funds or ESG funds are going to underperform due to the smaller universe. This is a clear graph, and this is the from Morningstar, so it is published. And please don't take it from me. Go do your own research and have a look at the performance numbers. But it shows that Shariah compliant and ESG funds using this framework can outperform, besides their benchmark, but conventional funds, non-Shariah, non-ESG funds. And I think that's the most important message coming from the slide. So if you want to preserve the planet, you want to help humanity, and you want to achieve great investment returns, then maybe, maybe these are the funds you need to look at. And whenever I speak to institutional clients or to retail clients, it's evident that they only put certain solutions in front of a client if they're specifically looking for a Shariah solution, or they're specifically looking for an ESG solution. But this should actually be seen as an asset class on its own to bring greater diversification and be part of a conventional product mix. So to conclude, I've discussed shared values, which is your economic benefit, your returns, as well as your social impact. There's clearly favorable demographic tailwinds in terms of millennials and female investors, and there's a clear increase in flows to sustainable funds, which we've seen. It's come off, but it's still positive, where on the global side and conventional side, it's actually negative. And that Shariah and ESG investing can outperform conventional funds. And while doing all of that, I think let's not take away that we are also making real grassroots impact within communities and delivering on those impactful and sustainable methods. So thank you. I can't see the time, but I'm sure I did that in under 35 minutes. I'm not too sure.
You did indeed.
I'd like to make this very conversational, and hopefully there are some questions.
Thank you. Let's open the floor and invite questions from anyone. I see Geraldine's given us a comment. Are there any other questions? Anybody who wants to maybe ask the question in person, just raise your hand and we can give you an opportunity. If not, any questions online? I have some questions while you were talking, just to start off the conversation. Sure. I think, you know, for many people in the audience, you know, we may be members of a board of trustees or you know, an advisor to the board of trustees. And when we think, maybe I'll put it into three areas. Firstly, it's sort of ESG, then the Shariah option, and you mentioned somewhere along the line that you said maybe it should form part of a mix. And so maybe let's talk investment, you know, so it's like an investment policy or investment strategy there. So starting off with the ESG and just that question, so it sort of ties back to question number 3. I know you're very focused on the product, but in your mind, how would if I'm sitting on a board, and then if I'm asking you a silly question, just stop me, you know, consider these things, because, you know, obviously I'm guided by my advisors, and the laws said for a while, you know, there's that guidance note from 2019 that says you need to consider ESG, and when I look at the methodology you put forward and your principles, there's so many. I think, you know, I'm overwhelmed when I have to, you know, consider ESG and then incorporate that into an investment strategy or policy.
I think there are enough vendors in terms of where even trustee boards or companies can subscribe to an ESG score or an ESG metric, and with doing that, they'll get a good understanding of what the good companies are and what the bad companies are. That's a very good question in terms of what I call the show me or the prove it question. And as you could see from the Sasol example versus the Shell, Sasol wasn't doing a great job. Now, you can never know if they're really doing a great job if they're not transparent with their metrics. They don't actually measure their metrics. So I think from a trustee point of view, they could look at a snapshot of the portfolio weighted to a certain score, and they could say, well, listen, the last time I sat in front of you, you showed me that your portfolio has a score of 6.5, and the benchmark at the current time was sitting at 5.5, which was great, but I see that somewhat has switched around. And please explain why that is. And then the fund manager would have to answer that question in terms of why they made the decisions that they did and why the ESG score is a lot lower.
So without sort of reducing the things you're saying there, just if I put it into an action, I would say, you know, if I'm developing the strategy, obviously I'm going to mention ESG. I mean, the policy, I'm going to mention ESG. In the strategy, I'm going to put in the metrics, and then you need to decide how you're going to obtain those, the metrics from either your provider, whoever the provider is in the value chain.
Correct. Because some fund managers are not going to be big enough to have a fully fledged ESG team only focusing on ESG. And that's the reality, but there are enough providers, Wayne, where you can get a good breakdown of how your fund looks versus the benchmark on an ESG basis.
So maybe if we can come back, thank you. I think that's a great answer. We have one question, one of our board members and exco members as a question, and we can get back to the Shari'ah maybe in case, you know, Enos has a question related to this. Over to you, Enos Ngachane, one of our IRFA board members and exco members. Thank you, Enos.
Thank you, Wayne. My question is around the board itself. I think you mentioned that the board is based in Bahrain. I just want to understand what are the functions of the board and what mechanisms are used by the board itself, you know, to monitor compliance from associates or country members. Thank you.
Thanks, Enos. That's a great question. So the IOFI board is the body that sets the standards in terms of the ratio. All Sharia compliant funds primarily follow that ratio. But then we also have our Sharia boards. So where our competitors will have a different Sharia board, and we'll have a different Sharia board with different scholars. The functions of that board is purely to keep compliance intact. So to make sure that the universe is what it is. You know, individuals saving in the Sharia fund or in a Sharia fund could actually be saving for pilgrimage. So while we purify that unit with a non-permissible income, the board makes sure, one, that the non-permissible income is actually stripped out and paid to charities. They also ensure Sharia compliance in terms of the ratios going over or breaching mandate. And an example of that is that I'm sure everybody on the call knows MTN, so I'm going to use that example. But if MTN goes out and goes and makes an acquisition for the old SAB and our Zabush, the Sharia board then is there to say they've made this acquisition. It's a big part of their revenue. This now falls outside of the universe. So that's the main reason for the board to ensure Sharia compliance. And they also issue a Sharia certificate, just like there are institutions that issue a halal certificate that your restaurant is halal. They issue a Sharia certificate. So that would be the primary function.
Thank you.
Thank you, Enos. I just having a look here. There are some questions as well. So maybe if we want to, we only have a few minutes. So I'm just having a look. So Kizwa and Gema asked, you talked about the impact of the fund, which are based And how are these based on, sorry, I'm just reading out. So I think it's about, the question here is, how do you set those criteria and your impact criteria? Yeah. You talked about, sorry, you talked about the impact of the fund, which are based on ESGs. Are these based on a set, on set targets that have been developed by the fund manager? If so, how are the companies performing against this? How were the targets set? So does it make sense? Sorry, I rambled a bit there.
Yes, yes. So every single company is going to have an ESG score, which is a proprietary ESG score that we build out. So that we incorporate into our portfolio optimization in terms of a hurdle. We would always want to be better from a fund point of view than the benchmark. That's the first thing. The other impact criteria is on the NPI that I mentioned, which is the non-permissible income. Okay, so while that needs to be stripped out, what we do with that is important. So we pay it over to a trust, and that trust is an independent trust that then allocates the funds. So from an impact point of view, we can't take that non-permissible income and go run a big marketing campaign. No, absolutely not. We're not going to do that. And we also want independence, and that process gets audited as well, in terms of where that money goes. And that money does not just go to Islamic institutions or Muslim institutions. Red Cross Children's Hospital is a big beneficiary of that. And where there's a need, like old age homes, and in the time of COVID, they needed oxygen machines. So that would have happened. And then again, as I mentioned, they opened a baking school, which is more the sustainability thinking coming through in terms of that strategy. So I think I've answered that impact from a fund point of view, as well as from the actual grassroots impact point of view.
So it's basically sitting down, defining the principles, and then seeing how you want to direct your impact. And you've been guided by the SDGs, if I understand correctly, but there could be other, ways in which you want to do it. But the SDGs are quite a well-known.
Absolutely, yeah.
So we nearly run out of time. One last question, which I thought is interesting and more, let's say, structural, legal type question. And if you can't, we can always refer it to somebody. Not that I'm saying you can't, but if we don't have time, is the question here as how can ESG Shariah investing, I think probably more Shariah investing, be integrated into underwritten funds? So I don't know if you understand the whole.
I'm not sure if that individual is asking from a product point of view in terms of a wrapper structure and life, more life company.
That's it. So an RA would be a policy, and your investment would be a policy, and an insurance policy.
Yeah. So that I'm going to try to answer the question the best I can. It's not my forte. I'm not in the product space. My responsibility is to make the best decisions from an investment point of view, but from a product building perspective, it's more of a financial advisor question. I do know that Old Mutual does provide a Sharia compliant wrapper, but that's about all I know.
Don't stress. I think it's a good question. Yeah. I think it's worth something that would be on people's minds. So we'll take it away and ask someone to help us with the a full response there on that structuring.
100%.
Thank you. I don't know if you want to have a closing remark or two. It's been great.
Yeah, Wayne, I mean, I just, I really value these sessions. I think, as I mentioned, education is important. And I would have liked a little bit more interaction perhaps at the end. And I know the feeling that this is a live webinar. There looks like there's 67 participants and people are shy to answer, to ask questions. But please, don't let that question hang. Send it through to Wayne and we'll do our best to get back to you if there's anything that you didn't understand. And yeah, I just appreciate that people took out the time today to listen to the webinar, and hopefully they're a little bit more educated about ESG and Sharia and the intersection, as well as how we do things here in terms of our active stewardship. So I must thank everybody for dialing in and listening to me. Thanks.
Apologies, now I'm not getting to the unmute button. Thank you, Maahir. We'll hopefully hear from you soon, and we'll send through these questions as well and get written answers, or share the answers. Thank you very much.
Perfect. Thanks. Enjoy the day. Ciao.
Cheers. Bye, everyone. I mean, well, bye, Maahir. Good morning. We're going to move along and introduce our next speaker. If you give me a sec, apologies, I'm just getting the camera on, and then we're going to introduce our next speaker. This time, they are indeed from Nedgroup Investments. So good morning. Morning, Jannie. What we're going to do is just give a quick overview who the speakers are. Geraldine and I are well known, and I'm sure you're well known to our audience as well, but just a quick hello. Then Geraldine has done the welcome for us, so I just want to move on quickly. Jannie, and we'll share these slides and your slides just so that everyone has a reminder of what this is about. If there are any questions, please remember you can raise your hand or you can post the questions in the chat or the Q&A. Jannie, would you prefer people to ask questions as we're going along, or would you like to finish and then take the questions at the end?
No, I mean, I think it's fine if the questions come as we go along. I think that's better.
Great.
Can I share my screen with my presentation?
You should be able to do that.
Okay, let me just try again. Okay.
There we go. Thank you.
Good. Good morning, everybody. So I thought especially with some of the draft or a further work that's been done on the draft on the two-part system that was released on Friday. I had a quick chat to our legal advisor that sits on that committee this morning as well. Of course, there's still a lot of uncertainty. There's still a lot of commentary that needs to be done on it. But I thought the concept, a lot of this, the elements of the system actually have similarities to tax-free investments. And I thought it would be a nice sort of like exercise to go through and sort of go through the tax-free investments. And it should be able to help trustees and decision makers to start understanding some of the trade-offs that are involved in the system, some of the complexities that it adds to the system, and of course, what are some of the alternatives, especially in the space where there isn't formal retirement plans. So, like I said, two-part system. I mean, the broad idea is to have an access pot, to have a retirement pot, and it's basically just to deal with like emergencies for the average member out there that doesn't have sufficient short-term savings. And therefore needs to dip into the retirements. And of course, we all know what happens is that a lot of the members then go and resign in order to be able to get the retirement savings. Like I said, I think there's still quite a lot of uncertainty in terms of how the access pot will be treated. I do think it adds significant amount of complexity. And I think this is still a remnant from the fact that in reality, I think what is required for a future fit kind of holistic saving solution for the average man in the street, to some extent, the existing institutions, which is, I mean, in the largest, and the institution that probably caters for the largest amount of people, are retirement funds. And to some extent, I think government's trying to sort of like be able to utilize this existing institution for things that it was never really intended to do. And I think this is partly where I think we as industry participants also need to start thinking about what kind of innovations can be created that allows one to, in a less complicated manner, deal with some of these challenges. But of course, those aren't things that happen easily, and they also don't happen over a short time. So I'm sort of going to focus on where I see some of the similarities of the access pot and the tax-free investments that was initiated in 2015. And as we know already, there are quite a lot of members also make use of other retirement structures to supplement the retirement savings. So in the cases of people that don't have formal retirement funds, or people that get annual bonuses or commission, some of them will actually add additional retirement contributions to a retirement annuity, for example. Now, as a starting point, I think it's important to start distinguishing between all these complicated terms in terms of these investments, and then there is all these different tax treaties. And I think one way to look at it is to sort of distinguish between the investment vehicle and the way the underlying investments are taxed and treated and accessible. And so broadly, if you sort of think about investment vehicles, these are things like unit trust, exchange traded funds. A lot of retirement funds that are sitting on umbrella funds are in what we call life pooled vehicles or segregated mandates. But all of these structures actually just hold the underlying shares, bonds, and whatever other investment instrument that the fund manager invests in. So basically, it's almost like the container that holds all those investments. Then this investment is almost like placed into a box and wrapped. And what that wrapping does is effectively, it determines how the underlying investments will be taxed and how it can be accessed and when it can be accessed. So it's a little bit, if you think about the rules you set for your kids when it's Christmas time, is they can only open the present on Christmas Day or on Christmas Eve. And those are sort of similar kind of things. So these are additional rules that's being placed on the underlying holdings. And that's really where retirement funds, tax-free investments, living annuities when people retire, and endowments come in, is that they change the way in which those underlying investments are taxed. Now, tax-free investments is one of those tax wrappers that offers some tax benefits. And like I said, the original idea behind it was to incentivize South Africans to start saving more, and specifically saving more for the long term. They are broadly based on the UK ISAs, which has been quite very successful. I mean, the limits are much higher in the UK now, but initially it also started with small limits, like an SA. I think it was 30,000 Rand initially, and now it's sitting at 36,000 Rand per annum. But I mean, the idea is that by encouraging people to save, they get the benefits on the tax, and of course that leads to better long-term growth of the investments. I think one of the differences to other retirement structures, such as the retirement funds or retirement annuities, is that they can be accessed. So like I said earlier, you ideally want to use it for a long-term investment, but in the cases of emergency, the fund actually can be accessed. In terms of the tax savings, it's really around the underlying investments. So it is the dividend withholding taxes that's paid, it is interest and income that is paid, and then it's finally when you withdraw, it's on the capital gains side. Now, in order to sort of like get an idea of what the differences are, I thought I would summarize the different taxes at the different stages of the savings journey. So firstly, you got the taxation on when you as an individual go and save. So in a tax-free investment, it is after-tax savings. So you would get your salary that gets paid after tax into your bank account, and then effectively you'll go and make a debit order into a tax-free investment. So it's already been taxed. In a retirement fund, of course, your employer, the employer generally will go and do the tax calculations, and you'll get the tax exemption on that savings. And so you'll see in it, there'll be an additional amount of disposable income versus somebody that would only contribute to a tax-free investment, for example. And then where somebody invests in something that doesn't have any of these special tax dispensations, in other words, I've just said basically like a no wrapper, whether it's a bank deposit or whether it is a unit trust, of course, that is also after tax proceeds. Then during the investment term, it's like I said, that's really where you get the big tax saving in both the tax-free investment and then inside the retirement fund. And of course, that's where the big benefit is versus a normal discretionary investment in any other form where there's no tax benefits. Then on exit or withdrawal, so I think this is where tax-free investment is a little bit different to a retirement fund. Effectively, you are not taxed on when you withdraw. So there's no capital gains or anything. Whatever you've saved up is effectively your savings. Whereas for retirement funds, of course, that's where your retirement tax or your annuity tables come in. Of course, there is some uncertainty how that may change in the two-part system. I mean, depending whether you're looking at the access part or the retirement part. When you don't have any special tax dispensation with no wrapper, of course, you have to pay your capital gains tax on that. And then on death, your tax investment is still subject to estate duty. There is on retirement savings within a retirement fund, of course, there's a estate duty exemption for all contributions that qualify for tax deductions. And then if there's no wrapper, there's also an estate duty. I thought it would be good to actually quantify, to start sort of explaining why these tax benefits are valuable for a long-term saver. Sorry, I was just having a look there. And what I've effectively done is I've looked at a standard balance fund that's used for retirement savings, and I've gone and calculated the effective annual reduction in the returns due to taxes. Now, the green bar is a normal unit trust. We just invest in the balance fund. There's no special tax treaty. And effectively, once you take the dividend withholding taxes that are paid within the fund, and remember, that's 20% of all the dividends that are paid on South African shares, effectively goes to the taxman as dividend withholding taxes. And that amounts to about 0.3% per annum. Now, for a high income earner that is a high marginal taxpayer and that has utilized the interest rate exemption, they can actually pay up to 0.85% per annum if you take that income tax on those income investments inside a balanced fund as well. So you can clearly see the tax benefit is significantly greater for a higher marginal taxpayer. Then if you compare that to a retirement or tax-free investment, where you can see at the current, this is sort of for a fund that is about 40% offshore, that reduction is only 0.15% per annum. So for the majority of members in retirement funds, that saving is about 0.2% per annum. Just as an illustration, I've shown, of course, these tax savings and tax exemptions are all on South African assets. So the increase in the offshore allowance has slightly reduced some of those tax savings during the investment period. So what I'm showing there is that once the offshore fund has been structured, basically what happens is, from a fund manager's perspective, you have to try and structure the offshore fund in the most tax efficient way, because you're not going to get any tax benefits within these various wrappers. I mean, on the ones that we've structured, where we get the benefit of the Irish double tax treaty, which is a little bit lower than what the South African one is, it comes to about 0.3%. But what you can see, there's no difference between somebody investing in a no tax wrapper or within a retirement savings. To illustrate the difference of what that makes in terms of long-term savings, I've gone and sort of like calculated it over a 15-year savings period. So if you think this is for somebody that has an annual income of about 180,000 before tax, they contribute about 3,000 Rand to the retirement savings or to a tax-free investment. Over a 15-year period, that grows to about 1.2 million Rand. If I used a simple, like just a long-term 5% above inflation return after fees for a balanced fund. If you didn't have any of those tax savings, so this is basically the green bar here, that 0.36%, you can see over 15 years, it's about 120. So you end up with about a little bit more than about 12% more in terms of savings. And of course, you can extrapolate that that's now over somebody's working career. It can make quite a big difference in terms of the tax savings during the investment period. And like I said, of course, a tax-free investment also benefits from this. But of course, you don't get the income tax deduction. So in other words, having a slightly higher disposable income, and I mean, on that 3,000 Rand contribution for somebody that earns 180,000 Rand, it's approximately 540 Rand, depending on the other deductions that are involved. So that, I think, is the big benefit between a tax-free investment and an effectively retirement savings. I mean, for that high income earner example, I think I calculated it would only have been 880,000 Rand at the end of the day. So like I said earlier, it's like a lot of these tax structures do favor higher marginal taxpayers more in terms of their benefits, which is why we've got all these limits in terms of only being able to contribute 27.5% or 350,000 Rand, etc., to limit the extent to which high marginal taxpayers can benefit from this. I think the other part, and I think this to some extent speaks to some of the challenges of what the two-part system wants to solve, is actually to look at tax-free investments and retirement savings in terms of the whole savings journey. And that's effectively what I've tried to do in this slide, where I've divided somebody's saving journey up into three portions. There is the pot that deals with short-term liabilities. So this is like saving for emergency saving for a home, a car, lobola, or a dowry for that matter. Generally, those kind of savings will be in bank deposits, stokvels, or unit trusts. The way the kind of risk protection that you require for those, so for example, if you buy a car, you can't go and put the whole amount down if the car gets into an accident, and therefore you need to take some form of insurance to protect you against some of those risk events. Generally, on those savings side, there's not a lot of offshore investments because the investment horizon is too short. Then the part that we're dealing with as trustees in the retirement industry is really your long-term liabilities. So these are the liabilities mostly. I mean, I think retirement is the biggest one. And then, of course, in some cases, if you want to save for your child's university education, that's also a form of long-term liability. And this is really where these tax wrapper kind of investments become important, because, like I've shown, they can add material benefits to the members' long-term savings, and therefore you don't want to go and squander those tax savings unnecessarily. And that's partly what you're trying with what I think Treasury is trying to do with the two-part system, is to ensure that there's at least one pot that actually gets all those benefits that grows, and then the long-term liability of retirement at least is covered. similar to the short-term insurance from a risk perspective. If something happens to you on the job, etc., you require some kind of income protection, and for long-term liabilities, that is death and disability, and of course funeral cover as well. From a offshore perspective, is typically between 40 and 50% of those assets will go offshore. And then the last bucket is for those that are fortunate enough to save money above and beyond what their long-term liabilities is for whatever they may desire. It may be left as a bequest, or it may be for a holiday home, etc. And those are really where your risk is managing the investment risk. And so generally one would use more offshore investments to diversify risk, to diversify the inherent investment side risk of it. Now, I think this framework sort of like illustrates, I think, the needs of most members. There is the shorter term needs in order to be able to deal with emergencies, to deal with the challenges of having to pay for bills. And I mean, as we know, during COVID, it hasn't been an easy time, especially on that shorter term side. And I think this is to some extent where I think in the future we do require some form of innovation in terms of how we think about building different pots as part of an individual's overall savings plan to deal with the discrepancy that of these short-term needs versus the long-term needs. Now, like I said, to some extent, the us as retirement trustees, I mean, our jobs are very much focused on the retirement side of it, but we have to deal with a lot of the complexities because some of the other building blocks aren't in place. And we've started looking at various ways where one could, for example, get somebody to first contribute. Their first contributions goes into an emergency fund. You put that aside, and then you start adding to the retirement pot at the employer level. But all of course, those requires innovations. It requires new systems. It requires ways to deal with other complexities. But I think some of those things are going to become really important to deal with the actual problem. And the actual problem is dealing with that short-term liability and finding the fine trade-off so that there is money that goes saving towards that long-term liability, which is retirement. I think the last part in terms of just understanding some of the restrictions, rights, and the way that the protection that it offers for creditors. So tax wrappers such as tax-free investments can be accessed anytime, whereas of course retirement funds are restricted as per legislation and as per the fund rules. Tax-free investments, like any other non-retirement savings, don't offer any protection from creditors, whereas retirement funds do. I don't quite know how the access, depending on how the access pot will be treated from a tax perspective. I don't know how that's going to have an impact on how it offers tax protection. We'll have to see how that the final drafts, I think, on the two-pot system or what it is in the end. Then, of course, in terms of financial rights, so tax-free investments, you've got the right to decide who inherits the money, so it is set out in the will. Whereas in retirement, of course, you only have a partial right. You can nominate a beneficiary, but ultimately the decision sits with the trustees. Then, in terms of investment restrictions, tax-free investments have got fewer restrictions than retirement funds. Retirement funds, of course, have to comply with Reg 28, whereas in a tax-free investment, you can have more equity, you can have more offshore, etc. Generally, when it's used for retirement savings, I mean, and most of the uses we've seen, people will use a similar balance fund in their tax-free investment because the intention is to use it for retirement. And so, as a summary, I think for me there are sort of three important points to sort of consider when thinking about tax-free investments and long-term liabilities, of which retirement, of course, is the biggest one. I think one of the big benefits with tax-free investments are that they are very flexible and they're accessible. And I mean, the flexibility is almost like on two sides of your long-term savings journey. It's like for younger people that may want to go and work overseas for a few years, you want them to contribute towards retirement savings, but they may want it in a slightly more liquid form, depending on what their long-term requirements may be. And similarly, at the retirement end, is that it also allows members to delay withdrawing from an annuity. They can access the accessible pot, and so hopefully by that stage, by doing that, they have a lower marginal tax rate when they start withdrawing from that annuity at the end. So there are some benefits in terms of how it allows you to sort of like utilize your different savings pots. I think the other part is that in the cases where, and I mean, I think this is of relevance to a lot of South Africans in the sense where there aren't formal retirement savings, I do think that TFIs are a nice alternative to start introducing people to saving for their long-term liabilities. Because it doesn't have all these like complex rules and the almost like the mental block of that people can't access their money. I think it may be an easier way in to get people that aren't contributing to any retirement savings to start getting them onto their journey. And then as they build that portion up, they can then later on move to more formal retirement systems such as retirement annuities, which of course are far more restrictive in terms of when you can access the money. So on RA, once you put, it's as a friend of mine once said, it's a Hotel California. You can check out anytime you want, but you cannot leave. So of course you can only retire at 55. There are limits, etc., etc. But so it does go nice in that space with retirement annuities. But then I think for most of our members in our formal retirement savings, I think it is a nice supplement. It's another alternative savings spot for that longer term liability. I know a lot of people that open up tax-free investments for their kids in order for them to get the long-term benefits of those tax savings, whether it be used for education or for their long-term needs. And I think quite importantly, it's an accessible retirement pool that allows for more flexibility at retirement. Of course, in the alternative space where it is used in the informal, and of course, this is not necessarily of relevance to a lot of us, but I think it is important in broader considerations in the industry, is there, of course, gaps when you don't have the protection of formal retirement structures and processes, is that if the individual only has a tax-free investment, they would require a will, a funeral policy, death and disability. So that's all the risks associated to long-term liabilities. I mean, one of the things that we've looked at is are there ways that if you do it via a digital platform, whether it be a banking app or some form of a savings app, whether you can put voluntary forms of restrictions on it. But like I said, those are, it's more in that space where you're not dealing with a formal retirement. So in conclusion, I think tax-free investments are similar in concept to a lot of the features of the access pot. I do think they are really good supplements to existing retirement savings, but they can also be used for other long-term retirement liabilities, like I said, or not retirement, other long-term liabilities like saving for kids' education, etc. I've already mentioned the use for where there isn't formal retirement savings. I think I've illustrated why these kind of tax wrappers that have got tax exemptions and savings do have material impacts over the long term. So while it's only 0.2% per annum, if you compound that over time, it does make a big difference in terms of the final retirement pot that a member would require to live from for the rest of their lives. Like I said, I think the two-pot system is trying to ensure that there's at least some form of money that ends up being there to cover that long-term liability. But like I said, I do think we are going to require a slightly more holistic approach to dealing with this problem. And I think that to some extent is really up to service providers in the long run. There's many challenges, of course, with all these things, implementing them, putting them into SAP, HR systems, etc. But I do think that those things are going to become more and more important to ensure that you cater for members' needs in a far more holistic manner. But a lot of those decisions, of course, will be with the employer rather than with the trustees on the retirement funds. And that's it from my side. I think we've got about 15 minutes for additional questions. I haven't seen any other questions coming through. Oh, okay, no, there is one. Yeah, so yeah, I mean, Johan, I definitely agree with you. I think the banks, I mean, we're having that conversation with our banking division, is I think they need to be in that long-term savings bucket. I mean, that's really the intention. That is where you get the tax benefits. I think for things such as like bank deposits, etc., it doesn't really make sense to use it. We have actually made quite a lot of progress on that in terms of how we are slowly but surely designing some of our banking apps, savings apps, etc., in terms of how those things are allocated. But yeah, I think fundamentally a tax-free investment needs to be seen as a long-term saving vehicle to cover long-term liabilities.
Jannie, and I'm not sure whether this is a question. We've got a hand raised. Nkululeko, do you have a question for us? Oh, maybe not. Jannie, and just to maybe get some thoughts going here as well. You know, as a retirement fund trustee, fiduciary, or someone who helps retirement funds in developing, you know, communication for their members, what you're putting forward here is, look, there's something else here. Is it, I mean, obviously trustees won't be giving this information directly. It's probably going to be more of an employer-based thing, but yeah, it would be around, again, probably financial literacy and just sort of making people aware of the options available to them. Because I mean, I think most people in formal employment understand banking to a degree, but I mean, these are some of the more difficult things that they may not be familiar with.
So look, definitely, I think it's unfortunately, it's always related to these tax savings and tax structures. The wrappers create a lot of complexity, which then creates challenges for the average man on the street to be able to understand them and know where to begin, which is, I think, where is why you've got such a large like financial planning business in many markets. I think simple frameworks to start getting people to sort of like understand where things fit in is really important. And I think if you can land some of those, I mean, we've got a behavioral scientist in our business, and she always says it's very, very difficult. You can't rely on education on itself. It's very difficult. There's a certain amount of processes, like the most successful sort of like the most successful solutions have been ones where you create some form of a default. Like, I mean, in our case, or in the States, is that auto-enrollment. So you join an employer, you immediately have a pension fund, you immediately have a pension contribution. And that's by far one of the biggest way, or the most important ways to ensure that people start contributing towards retirement savings. But I think the conversation around the importance of building up an emergency fund, for example, having 3 months of your salary saved up is a really important one, because if that savings pot, if you can get to it now, and I mean, I think this is the challenge, of course. If you don't have a lot of disposable income, it's very difficult. And so that's why I think that some of the conversations that, and these are conversations really that I think, like you say, are ones that you have to have with the employers, is to say, are there alternatives to saying, can you fill some of the buckets first before you start contributing towards the retirement pot, as a way to ensure that there is this emergency a pot available, and that you don't end up with all the complexity that we're sitting with, which is partly now what the two-pot system is trying to resolve. But I mean, anybody that's been involved in that process, it adds a significant amount of complexity. And the main reason for it is that retirement funds are all about long-term liability, but now you're trying to cater for short-term liabilities within the system, and the system isn't really geared for it. So I don't have all the answers. Like with all these things, it's very complex. There's quite a vast amount of stakeholders involved. But I do think if we start having some of these conversations, and like I said, it's both at the retirement fund level, but also probably more importantly at the employer level.
And I think maybe that's what my thinking was around that one, is that, you know, when you have a captive audience, and I don't mean that in the negative, in the sort of negative way, you know, like it's your greatest opportunity to help people, you know, understand the universe of things available to them out there. And I think maybe one of the other features is, you know, it's always about budgeting and whatever, but I mean, this is just a personal view. I think the less money you have, the more careful you are at budgeting. You know, you have to become, you know, even better at budgeting, you know, for everything you need to do. And I mean, there are lots of low-income South Africans that have remarkably been able to save, you know, for education or for weddings, you know, dowries or lobola, which, you know, in various ways. You know, so I'm rambling a bit, but I think, again, it comes back to that, make people aware of what the options are, and maybe, you know, when we communicate or share these things, just say, yeah, here's another option, and why it's of benefit to you. And there's some things that are really worth making the time as trustees. And I know many boards of trustees have financial literacy campaigns where they obviously explain what retirement funds are, but they also talk budgeting and all these other options. So maybe it's about making trustees comfortable with this as well, you know, if this is part of what they need to do.
Yeah, but like I said earlier, I think if you can make it some form of a default way that's linked to payroll, etc., that's by far the most effective in terms of making actual differences. But like I said, I mean, those are things that HR departments and employers really need to look at. But I think it is, I mean, many of us as trustees are, I mean, quite often you'll find HR people sitting on trustee boards. And I think so, when you put on your employee or employer hat, I think it's important to sort of like think of those considerations as well. We all wear multiple hats, but it doesn't mean that you can't like sort of like get the best of both by applying things that will make a material difference to people's savings.
Thank you. And I think this is a conversation we will definitely continue to explore other ways and creative ways of helping people build that capital that they need for retirement. And if there are any other questions, again, you know, just a reminder, we'll share the slides with everyone, and our contact details. Please feel free to talk to us or send an email, and we can then post and ask any questions there. And yes, I want to hand over to Geraldine. Thank you, Geraldine.
Thanks, Wayne. Jannie, thanks very much. As always, I always wonder how you manage to learn so much, that you can talk about so much. You always entertain us with some interesting talks. So very much, thank you very much from our end. I just wanted to ask you, so if we say an employer says, right, they are going to facilitate some kind of savings scheme for their staff, what type of product or what facility would they be able to use to do that other than just sticking it into a bank?
Look, I mean, there's multiple short-term savings vehicles that's available. So, I mean, you can make use of unit trusts, and then, of course, unit trusts, of course, come in various investment types for different investment periods. Like I said, some people use stock. I mean, I think stokvels are probably the biggest form of shorter term savings in SA. I think generally the biggest benefit is almost the act of saving. So, I mean, it's nice to get additional yield and additional returns, etc. But really the biggest, I think the thing that's the most important is just the actual just moving the money aside. The real benefit when you're talking about returns and compounding and tax is for that long term where your money sits and is invested for 20, 30, 40 years. That's really where you get the big benefits of compounding. For short-term needs that are 2-3 years, there are differences, but they are quite small compared to what those longer term ones are. So I'm to some extent I mean, there are various options that investors can look at. And like I said, I think all of them will work fine. I think the important one is not to go and try and use your retirement fund kind of risk profile for your short-term liabilities, because then you can deal with the market volatility can work against you. But really find something where you can put your money away so that there is some savings. And then when it is required, you can access it instead of making use of debt. Or, like I said, wanting to dip into your retirement pot. And I mean, like I said, I like the concept of making it a default, making it automatic. I mean, there's been so many different like apps and stuff across the world where they get you every time you go and buy a coffee, they nudge you to say, but don't you want to rather save on the coffees and or add R2 to your savings account or R5 to your savings account. So to get better savings behaviors. I think if you apply that at source when you get your salary check and it's not part of the money that enters your bank account, I think how people budget and how they deal with the amount of money that sits in their account then has less of an impact on that savings. And that's why I do think if you can put it in some form of a default automated, it automatically goes to that pot. I think you've got a higher chance of it working in the long run than simply through education, etc.
Thank you, Jannie. If there are any other thoughts or anything else you want to share, we'll share your presentation with everyone. And again, we'll remind everyone to share their questions. Don't think there are any other questions at the moment. So thank you very much.
Thanks a lot. And yeah, like I said, I think these things we just need to, it is about these important conversations and about the conversations we have with the various stakeholders that are involved. But thanks again. Have a lovely day.
Thank you, Jannie. Keep well. Bye-bye. I'm going to move on and invite our next speaker. We'll put up the slides for them now in a minute. Well, the welcome slide, and then they'll share their slides with us. Give me a sec. Apologies, I just want to change the slides here for us in the background. And then for our next session, session 3, another new one or a different angle, as was the idea for today's session, is we're going to invite Errol Shear from Sasfin Asset Managers to talk to us. Again, we'll share Errol's credentials, and Errol, as you can see from the topic originally, is going to talk to us about providing a solution for more conservative retirement fund members. Errol, I'm not going to say much more. I'm going to go over to you. Welcome, and thank you for joining us this morning.
Good morning and thank you. I'll just get my...
I'm just going to stop sharing here. Sorry, Errol. There we go. You should be able to share now. Yes.
Okay, good morning. I'm going to talk about investing in unstable times, particularly for the more conservative member of retirement funds. Firstly, some common investment myths and misconceptions in the retirement industry. Myth number one, stock markets always go up. You may have to wait a year or two. Well, I think back to 1989, when the Japanese stock market peaked. That was a third of a century ago in 89. It is still a third lower than that. So yes, stock markets go up, but sometimes if you're a retirement fund member, do you have the patience to wait 33 years for the stock market to recover to where it was? And Japan's not back to where it was yet. Russia's similar. 1998, it was a similar level in dollar terms to what it was when trading was suspended for American investors a few months ago. Myth number two, if you take risk, you will get higher returns. I'm not so sure about that. If I think of Bitcoin, if you took the risk and bought Bitcoin last November at $70,000, and today that's worth $22,000, you certainly have not got higher returns. Myth number three, you cannot get good returns without taking risk. More risk does not mean high returns, and you can get good returns actually without taking risk. I'll show you our returns later. Our low risk portfolio returns actually have been fairly decent over the years. What are the market concerns? Currently, there are many concerns. War in Ukraine, in Europe. What's going to happen with Taiwan and China? I think the Chinese will be patient, but that is a question which will remain for beyond today. Oil price back to almost the level of the 1980s, inflation, recession, maybe. But my major concerns are that central banks have been pumping cash into economies. We've had 40 years of falling interest rates in Western countries and a little bit of a blip upwards in the last few months. Let me explain what I mean by this. If we look at global debt is fast approaching $300 trillion. This is massive and has to be repaid at some stage. You can see the big increase, particularly during COVID. If I look at America, at the Fed in particular, the American Federal Reserve has a massive balance sheet. They've built up assets on their balance sheet from virtually nothing to about $2 trillion in 2008 to try and calm financial markets. And they thought this is a great thing. And then they raised that further. And then during COVID, this was raised to about $9 trillion of assets sitting on the Fed balance sheet, which shouldn't be there. Now, the Fed has to unwind this balance sheet at some stage by selling off assets. And I don't think any of us know what this will do to market valuations around the world. So a bit of caution is needed here. If I look at the Johannesburg Stock Exchange, our own market, where a lot of our focus goes, on a long-term basis, our stock market is slightly cheap. The long-term ratio of prices to earnings is just below 13, and we are currently sitting at about 11 times historical earnings, with some growth still to come through in the market. So our stock market actually offers reasonable value on a global basis. If I look at the American stock market, not quite the same story. This is the S&P 500 index ratio of prices to earnings. the higher, obviously, the prices are relative to earnings, the more expensive the stock market. The historical average has been about 19 times earnings, the red line in the middle, horizontal line, and we are currently sitting at about 21 or so times historical earnings. So that would make, on a simplistic basis, the American stock market slightly expensive. But what is a PE ratio? PE ratio of price to earnings. It's the ratio of prices of shares, and those you can see what the price of Amazon and Walmart and Citibank is. So prices are easy to discover. What are the earnings going forward? And this is my concern. If I look at America in particular, look on the left-hand half of the graph for the first 20 years, the 80s and the 90s. You can see the two black lines. On average, the ratio of profits after tax made by American companies relative to the size of the economy was around about 5%. So 5% of the total economy went to after-tax profits by American companies. Look at the last 20 odd years. That has now doubled up almost to about 10% of the total economy is going to American companies after tax profits. That is a very, very high ratio. Just thinking about it, 10% of the economy going to after tax profits to American companies. That is massive. Now, will that remain as high in the future? Now, what are profits? Profits are sales, which probably will come under pressure next year as the economy slows down. But even if it doesn't, profits are sales, less expenses. Now, costs are going up now with inflation. Wages, in particular, are rising quite fast. So that should reduce profit margins in the States. And then you have to deduct interest. Now, interest rates in the States have been virtually nothing for many years, particularly since the great financial crisis. And those interest rates are rising and will rise further. So that will also come off the share of profits taken by American companies. And then taxes. Taxes have been reasonably low. Think of Trump and his policies. Tax rates are likely to rise in the USA. They have to repay some of that massive debt taken on by the American government, by the Fed. So for all those reasons I've just expounded, I think the earnings in America we've seen are not sustainable over the next few years. So I would say the price earnings ratio in America will rise from slightly expensive to a lot more expensive as the E comes down in the price earnings ratio. So we are underweight American and other international equities. If I look at bonds, if I compare the South African 10-year bond rate to the American bond rate, our 10-year bonds yield close to 11%. American bonds yield close to 3%. That's a differential of 8%. So behind the African bonds, we have an 8% higher interest rate guaranteed if we hold to maturity in local currency, admittedly. And I think that compensates for a lot of risk. I'd rather have the bird in the hand than two in the bush. So I'm happy to have a lot of fixed rate bonds in our portfolio at the current high rates that we can get on our fixed rate bonds. If I look at the yield curve, that's the difference between 10-year bonds and money market or 3-month JIBAR. Again, a differential of 5%. We are paid 5% to hold bonds rather than cash. I'm happy to receive an extra 5% and hold bonds for our stable fund rather than holding cash. Inflation linkers, one of my favorite assets. We are trying to deliver to our clients inflation plus 4%. Not a bad return if all our retirement members get 4% real over time. That should end up with a good pension if they save consistently over their working career. This is the I-2038 bonds, yielding over 4% if we hold to maturity. Again, a good yield for our portfolio. Then let's look at inflation. What's inflation doing in this country? It's very important for any pensioner. You want to know that your investment returns will exceed inflation. It doesn't really matter if the price of petrol and bread and rice and accommodation is going up a lot or little. What is important is that the pensioner is enjoying, or future pensioner is enjoying, a return on his investments or her investments which exceeds the rate at which prices are going up. Now, if you look back over the last decade, the Reserve Bank has done a very good job in the main of keeping inflation between the two black lines. The Reserve Bank's mandate is to try and keep inflation between 6% and 3%, the two tram lines there. And with a couple of minor blips, it has done that over an extended period. Now, we've seen inflation shoot up to 7.4% in South Africa last month, and it could rise further this month. But the Reserve Bank has taken appropriate action to counter inflation by raising interest rates. We saw a 75 basis point rise in rates a few weeks ago after several earlier this year. And that is the right thing to do to bring inflation down before it goes out of hand. The Americans are doing the same. It's the right thing to do. The Europeans have been very slow to do similar. But certainly in this country, the Reserve Bank is doing the right things technically to control inflation. So our view is inflation may rise in the next few months, but should start coming down hopefully next year. But irrespective, our target always is inflation plus 4%, whether inflation is 7.4% or 3.4%. If we look at American interest rates, 10-year bonds as an investment have recovered from the very, very depressed levels during COVID. They went down to under 0.6%. Last night, they're back up to 2.71%. Much better rate, kind of in line with it's been the last few years, the last decade or so. But obviously well below their inflation rate. Could this rise further? I think there is some risk that it could rise and one could see losses on one's American bonds, but I don't really see it going much above 3 or maybe 4%. If I look at short-term rates, we've seen this big spike in American inflation up to 9.1%. American interest rates, the Reserve Bank there, Powell's done also a very good job of raising interest rates quickly to try and counter inflation. Also, they had a 75 basis point increase recently. They are taking action, and Powell has said they will do whatever it takes to tame inflation. Now, inflation in America, it's higher than in South Africa, and it's also become more broadly spread. At first, we thought it was only because of supply chain disruptions, and then the oil price and food prices. Oil price, we think, will probably stabilize sometime next year. Food prices have rolled over, but the core inflation is a little bit more than it should be. So I think we'll see several more rises in short-term rates in the States, but it does look they will do what is required to tame inflation in the States. On Germany, a similar question. Inflation has soared in Germany. Interest rates have gone from negative short-term rates to 0.2%, still very low. But Germans, surprisingly, well, the European Central Bank, have been very slow at taking action to counter inflation. And this is not a good thing. If you're slow to take action, you have to do more for longer. And that concerns me. What will the effect of this be on the European economy? They really have to have the problem of shortage of gas supplies, given that the Russians have throttled back the gas supply. I do have questions about Europe. If I look at the Rand, this is the Rand, the real effective exchange rate based on inflation differentials, and looking at all our trading partners. And looking at all our partners, we tend to only look at the dollar against the pound, against the euro. We've actually been reasonably solid over the last year or two. But against the basket of currency, the Rand actually is slightly cheaper than it should be on a long-term basis. So on the Rand, we are not as pessimistic as some of our peers. Now, let me come to the nuts and bolts of what we're trying to do in the SASFin stable fund. We run the unitized stable fund. We also run for pension funds, self-standing funds on the same basis. Our objective is to give a return of inflation plus. Typically, inflation plus 4% is a long-term target, but we are trying to do that with lower risk. Many of our pension fund members do not want to see the value of their hard-earned savings take a big knock and they'd be happy with a 4% real return, but with lower volatility, and not have to wait 33 years like in Japan for markets to recover. We have a core of fixed income assets, which give us a nice steady income to support the fund's return. And then we're adding equities to give us a slightly higher return, but with a maximum of 40% of the portfolio in equities. We risk control in two ways, both strategically and through individual stock selection. What I mean by that strategically means we'll vary the exposure to asset classes like fixed rate bonds, inflation linkers, shares, and property, depending on where we are on the cycle, looking at expected returns and risks to each asset class. And then within each asset class, we look at individual stock selection. So we try and avoid the more risky type of bonds. We don't buy sub-investment grade credit, and we don't buy what we perceive to be very risky type shares. The emphasis is very much on asset allocation, and the portfolio is unashamedly designed for the more cautious client, particularly those retired members who are post-retirement and need to draw off a steady income and cannot afford to lose a big chunk of the pension fund assets, or for those members that are within 10 years of retirement who also cannot afford close to retirement to see their pension fund investments take a big knock. Our current positioning, we are overweight inflation-linked assets, giving us 4% plus. We are overweight fixed-rate bonds, giving us, in nominal terms, close to 11%, with inflation at 7.4%. That is giving us around about 4% real. And we do think inflation will decline next year. We are overweight a little bit on South African equity, but offshore we're underweight. We're underweight property because we have some concerns about the oversupply, particularly of office property. And then we have reduced our money market on the basis that we can get better returns than money markets from other asset classes. And just coming back to the way we invest. Now, stable does not mean you cannot see some exceptional returns. If I look last year, some of the shares in our portfolio, PP Cement was up 266% last year. Impact, the packaging company, was up 153%. Royal Bafokeng Platinum, which we sold to Impala Platinum to the point of sale, was up 145%. Lewis Stores was up 113%. Sasol up 93%. So within the portfolio, we can still get some very good return from some of our selected assets in the stable funds. Stable and conservative and cautious does not always mean low return. I'd then like to just touch on Regulation 28, or the recent changes, which will come through in a few months' time, and the effects on our approach to stable investing. Firstly, cryptocurrencies have been banned, makes no difference to us. I mean, the thought of buying a Bitcoin, I like to see yield support the valuation. There is no yield on cryptocurrency or on Bitcoin, number one. Number two, there is no ways of objectively determining what the fundamental valuation of a cryptocurrency should be. I do not believe in buying assets when you cannot determine what fair value is. If you bought last year $70,000, it's now $22,000. I cannot say whether $70,000 last year was a fair value or recent valuation of $22,000 per Bitcoin is fair value. For me, that's pure speculation. You can go to the casino and you'd have a little bit less than 50% chance of being red, or slightly less than 50% chance of black coming up on the roulette wheel. And you can go to the casino, play the roulette wheel, put all your money on black and double your money. It's possible. But that is not the right way to look after retirement fund savings. Not at all. So cryptocurrency does not even enter the risk of assets we think of in our portfolio. The second change, besides banning cryptocurrencies, was introducing an asset class called infrastructure up to 45%. Well, first I would query 45%. I do believe in diversification, and would query whether 45% in any one asset class is maybe not a bit too much for prudency, but that is my view. And then I think of infrastructure. Is it a good or bad investment? And my mind goes back to the largest infrastructure projects we've seen in South Africa in the last 20 years. And what are they? Firstly, Medupi and Kusile power stations, both cost more than double what they were budgeted to cost. Neither of them are complete yet. I think they were meant to be complete about more than 6 years ago. So the IRRs are never going to look great. If I look at Transnet's major infrastructure investments, particularly locomotives, that's also been a disaster. So infrastructure can be bad also. But having said that, there are some potentially very attractive infrastructure projects in the pipeline. I think of the solar power generation, where the returns can be attractive. So we are looking and will be looking at some of these projects, but there are a couple of caveats. I would not like to put too much in any one project because there are risks that we've seen with other infrastructure projects. There also is quite a while to wait before you see any cash flow return, so that increases the risk. They are difficult to price, so valuation becomes a problem. How are you fair to different generations of pension fund members? In the early years, typically infrastructure, you get very low or even negative returns. That is a typical curve of return on infrastructure. So if a member withdraws in the first year or two, do you penalize them by giving them a zero return on a project they've funded for the longer term good of the other members? And how do you value their share of the fund that they're withdrawing? Infrastructure is very difficult to value. So we'll look at it, but it would depend on the vehicles available, how easy they are to value, how liquid they are. Infrastructure by its nature tends to be very illiquid. And I do believe it's important to have some flexibility in any retirement fund. There are periods when you need to draw cash, there may be retrenchments or other reasons for liquidity being required. So I would not be happy having too large a portion of our stable fund in infrastructure. If I can look in summary at the principles we apply at SASFIN in our stable fund investing, firstly, beware, there are unknown risks. The known risks are usually priced into markets. The unknown risks are not. If you think back to 2019, how many of us thought about COVID? We knew that in the Middle Ages there were plagues, but we would not have factored it into our investment thinking. Therefore, I'm always concerned about the unknown risks. Therefore, diversification is always important. We believe in using all the major asset classes because the unexpected can happen and diversification does reduce risk. I believe in keeping it simple. I always think the risk is greater in complex structures than it is when you keep it simple. And also, the simpler you keep it, the lower your costs are. I believe it's very important for our retirement fund members that we keep our cost under control. I believe in using prudent limits. We always think that we know everything, we can forecast the future. Unfortunately, there are unknown risks. Prudent limits stop us doing anything too foolish with our retirement fund assets. So we always stick to what we consider to be prudent limits, which may be even lower in some cases than the Regulation 28 limits, for instance, with infrastructure. We focus on delivering inflation plus with lower risk. And we've delivered it. The proof lies in the track record. If I go back to the graph here, you can see on the right-hand side, the blue line is the index return on retirement funds invested in the stable space going back decades, run by the current manager of the SASFIN Stable Fund. The gray line is the benchmark or target of inflation plus 4% per annum. And you can see two things. The blue line remains fairly stable. The SASFIN Stable Fund and its predecessor funds have been run in a manner which provides a fairly stable return. Other than during the start of COVID, there have been no major blips in the index return. These are monthly figures. The gray line, and also it's stable and it's above the gray line. we have delivered on our target over time of inflation plus 4%, which I think most pension fund members would be happy with in the longer term, given that there is less risk in the way we run portfolios. The proof does lie in our track record. The fund has done well. Last year was an exceptional year when the stable fund produced almost 26%. We think it is a great way to invest for the more cautious investor, for those members of retirement funds who are either post-retirement or within maybe 10 years of retirement and want to be a little bit more cautious in the approach. Also for members who are less sophisticated or don't have huge amounts of savings where there's a buffer to cope with the unexpected. This is the ideal investment vehicle for our retirement fund members. Thank you very much for your time. Are there any questions?
Errol, thank you. Let's see if there are any questions. Just give me a sec. I see we've got a question from Geraldine. Geraldine, do you want to go ahead, please?
Thanks, Wayne. Morning, Errol. And just really first off, from IRFA, thanks very much for the support from SASFIN and taking your time to come and talk to us. It was nice, and I'm sure it's nice for our attendees to hear from a different player also. I thoroughly enjoyed your talk. Very interesting to get some of your insights. Can you give us just a bit of background as to your approach or your views, as far as, I know you spoke about the infrastructure investment, but a little bit perhaps about ESG issues and what really a typical trustee would need to hear from you guys when they look at the portfolios?
Geraldine, ESG is very, very important to us. I mean, our belief is that any company in which we invest, which does not apply sound ESG principles, will not remain in business for a long time. It does not have a future. So we would screen all our investments to see if they are dealing well with ESG matters. The emphasis on ESG does vary over time. So we've seen some evolution. I see in Europe, for instance, they were very strong on the E of the ESG, particularly on burning of coal and carbon levels. I see now with the shortage of power, they've relaxed some of the restrictions there. We're also very concerned about companies doing what's called greenwashing, where companies claim a high level of compliance with ESG, but they're not really compliant. So I think there's a great need for the auditing profession to get more strict on auditing some of the claims made by these companies on ESG. In South Africa, obviously there are different aspects to ESG. We have different democratic drivers here. But certainly, we are very nervous about investing in companies with poor ESG levels. And just on ESG, I mean, I'm a bit of a greenie myself in particular, and I do worry about pollution and global warming. We've seen some of the hottest days of summer in Europe this year. We've seen huge changes in climate around the world. I look at a company like Eskom, for instance, which was one of the world's greatest polluters. Now, we don't have any Eskom bonds in the portfolio. The main reason for that is actually just the credit that Eskom, without a government guarantee, is not creditworthy. So we have no direct exposure to Eskom, mainly because it is not creditworthy and doesn't suit the culture of a stable type fund. At the same time, it is a big polluter, and we always thought, if it had a decent balance sheet, could we actually invest in Eskom, given its very, very poor green credentials? And then areas like governance. We look at AGMs to make sure that companies are compliant with our standards of governance. Has the chairman been too long in office? Are there conflicts of interest possibly between some of the directors and the interest of shareholders? And we have voted against companies where we believe they're not applying proper governance. On the social side also, a good corporate citizen must comply with the standards of the country in which it operates. So in all three, E and S and G, we are very, very strong on making sure that our investee operations are doing their best to comply with ESG as it evolves. Thank you for your question, Geraldine.
Thanks, Errol.
Thank you, Errol. There aren't any other questions, but we do want to remind everyone that you have an opportunity after maybe rewatching the session, maybe having a look at Errol's presentation again later, to post any question or to write to us, email us, and we'll definitely get back to you and share your questions with Errol and the team there. Based on the fact that there are no more questions, I think we're ready to finish the session, end the session. Just thank you very much for attending. Thank you for everyone who was part of the different approach to our thinking today. The three different areas, we will definitely think of doing something like this again in future. I think it brings a lot. And thank you to everyone who's been involved and did all the preparation work here, all the speakers, obviously. Thank you to Enos and Gachane, and I see some of our other board members that have also attended. Thank you for attending, Cheryl Ward. And keep the questions rolling, ask questions so that we know what we can plan for the future. And also thank you for everyone sharing their thoughts on the presentation. We will share this later on. And please post those questions. We really like to hear from them and see how we can contribute to the sector as a whole. Geraldine, are there any final words you want to say before we end the session?
No, Wayne, I think you've said it all. Just a great big thank you from myself also, and the IRF board, and thank you to you and the office as always for arranging this. We appreciate it. We know it takes a lot of planning in the background. And we'll see everyone at conference.
Yes. Cheers, everyone. Bye-bye. Thank you for joining.